Good afternoon, everyone. Welcome to Space42 Pro Forma 9 months 2025 earnings call. I'm Bruno Priuli, Head of Investor Relations and your host for today. Joining me today are Karim Sabat, Managing Director, and Andrew Cole, CFO. Before we start, let me go through the usual housekeeping rules. Our participants are currently in listen-only mode, and we will have a question and answer session at the end of the presentation. In the meantime, please feel free to post your questions in writing on the chat as we go through the slides. I'll then read them out during the Q&A session. Please include your name and your organization. You can also ask questions orally by using the raise your hand feature, and I'll hand the floor over to you to announce yourself and ask questions. For any member of the media, please share your questions separately with your corporate communications team. Please note that Safe Harbor applies, and the replay of today's webcast will be recorded and made available on our website. With that, Karim, over to you to start us off.
Thank you, Bruno, and welcome everyone to the Q3 briefing on our results. Q3 was a constructive quarter, and we are making considerable progress on our strategy execution with commensurate results. Now, our focus remains on executing our strategic plan, which covers the two facets of our business. On the one hand, the geospatial data and AI platform services, and on the other hand, our SATCOM-related services, including non-terrestrial networks as well as secure connectivity. Starting with the foundation that we are setting for our sustainable growth, we have made significant progress, as I briefed you earlier this year, on the deployment of our Thuraya 4 spacecraft and the bringing it into use, which is starting to generate revenues. And as Andrew will cover later on, it was one of the drivers of the growth we have achieved in our satellite services business. Smart solution remains a focus of our efforts so that we transition from project-related engagement to capability-centric programmatic engagements going forward. Our priority now is to make sure that we are building the capabilities for the future, whether it's at the level of the infrastructure deployment in space, as well as the development of associated infrastructure on the ground and the software platform, specifically GIQ. And we've come a long way over the course of this year so far. And particularly, we have achieved an important milestone. In fact, a few days ago, with the successful launch of Foresight 3, 4, and 5. So we are well on the way. We recognize that this remains a work in progress, and this explains the shortfall in our revenues within this particular business domain. But nevertheless, what is important is that we remain focused on our objective to build programmatic capabilities that can achieve programmatic growth. And we're well on the way to sort of bring into operation these capabilities, which we have been deploying over the course of the past 3 quarters. Our strategic execution was particularly marked by the announcement of Equitas, which is the joint project we are prosecuting with Viasat, specifically the deployment of a non-terrestrial network in space that would serve unmodified devices over the next 3 years. So this is a development that we have started, in fact, back in March. If you recall, we announced an MOU for a technology-related collaboration between Viasat and Space42. Our objective was to validate our hypothesis that we can build an infrastructure in space that can effectively deliver a superior user experience on unmodified devices, i.e. the devices that you and I use every day, and also be able to do that with a unit economics that ensures that this user experience is within the economic envelope that we are used to within our traditional or our day-to-day mobility services experience. And so here we are, having validated the technical design, and now taking a view that we should move into the setup of this joint infrastructure. And as I will explain later, our objective in deploying Equitas is to create a shared infrastructure in space. At the start, it is shared between Space42 and Viasat, and in the future, it will attract other satellite operators as well as spectrum holders. And in fact, these conversations are well underway. Now, all of this is underpinned by our strong financials. So we have the right fundamentals to be able to prosecute all of these objectives, and Andrew will elaborate on these later in this conversation. Moving on to page 7. Just as a quick reminder, our 4 core pillars remain firmly anchored, and so our objective is to achieve our rightful place as a preferred partner for premium geospatial data, whether it's data that we will deliver through our proprietary assets, specifically through the Foresight system, or data through our partner network, so that we have a truly responsive service that can deliver Earth observation-related data if and when required, whether it's in the civilian domain or in the government domain. At the same time, what is quite unique about Space42 is that we are equally interested in deriving the so what of this data into actionable insights, hence our core pillar number 2, and our focus on developing the most formidable geospatial AI platforms, specifically GIQ. Some of you may recall that GIQ was recognized as a formidable technology platform that, in fact, received the future-proof seal by the UAE federal government. While I'm not in the liberty of disclosing at this stage the entity, but GIQ has gone through a very lengthy qualification and selection process by a global organization that serves many nations around the world, and pound for pound, it was identified as the superior platform against other platforms, whether emanating from Asia, Europe, or North America. And so it says a lot about the value of the efforts we have put today in developing this particular capability. Core pillar number 3 is the non-terrestrial leadership that we are prosecuting. And this, in our approach, is viewed as a generational opportunity, since this total addressable market that we're prosecuting today is something that surpasses anything that our industry in general has been confronted with, and I say confronted anything in a positive manner. And so this is a whole new ballgame for us and for the rest of the industry, but certainly we're taking the lead right out of the starting gate on this front. And last but not least, going back to the raison d'etre of space services, the legacy EASA, secure connectivity remains front and center to our service offering, and here I will expand more about our programs and present and the future. The point also I want to emphasize is that the autonomous mobility remains a thematic focus of our strategy, and in fact, the recently executed agreement with A2Z, which is a formidable partner based in South Korea, to deliver autonomous mobility, whether on new vehicles or for retrofitting existing vehicles, is a new leg in our strategy in this particular thematic application. Now, let me add a bit more colors on what we're doing along the 4 pillars. On 4 pillars 1 and 2, in particular, the Foresight constellation development is well underway. Not only we have successfully deployed spacecraft 3, 4, and 5. These were assembled, integrated, and tested in the UAE in tandem with our technology partners, ISI. And these remain today the most advanced SAR-based Earth observation assets that are commercially available, and only a handful of nations have access at present to these capabilities. So in a sense, it speaks a lot for the quality and the future-proofness of what we are doing. But as I've always said, this is a continuous process of developing and building and making sure that technology insertions are happening as we deploy new assets. and we do that in the most cost-efficient manner. So it's a journey, and we're very satisfied with the vector of this journey. But again, I want to sort of emphasize that this is a constellation that will continue to develop within our sort of capital deployment plan. Our objective is to reach a point with the 7 spacecraft where we can serve the sovereign requirements in the UAE, but also be able to serve commercial opportunities regionally and globally. Map Africa is the second execution of core pillar number 1. Specifically, it's a endeavor that we intend to pursue with 2 of our partners, Esri and Microsoft. There has been enough media coverage around it, so I don't want to spend more time on it. The point I want to make is this will be quite transformative for the African continent, since it will bring for the first time base mass with levels of precisions that can be quite insightful and in fact unprecedented in terms of value to a number of economic sectors as well as sectors that are served as part of the government role in all African nations. And last but not least on this particular phase is the continuous progress we're making on our geospatial analytical platform, GIQ and GIX for non-civilian applications. It has now been launched on the Microsoft Azure Marketplace, so we moved from an in-house on-prem platform to a platform that sits on a global marketplace that is cloud-based and that can serve multiple users around the globe, which in a sense is one of the reasons why GIQ was down-selected, as I've mentioned earlier, as part of a 1-year plus review process by an international organization. And more about this in the following weeks and months. Moving on to core pillar number 3, I want to add a bit more colors because on this particular progress, since we haven't had the opportunity to talk about it to the investment community. And this is a good place to anchor the main tenets of this program. So we announced in September the plan to set up Equitas, which will be a joint project we are pursuing with Viasat. And our objective, to make a long story short, is to deliver a continuous mobility experience to everyday users on their unmodified devices, and also to be able to serve in a unconstrained manner all the IoT universe, which today tends to follow a plethora of different standards. And for us, our approach is 5-pronged in terms of why this is differentiated. First, as a business model, this is meant to be a powerful setup in space, i.e. this is a shared infrastructure at the moment between Space42 and Viasat, and we're in active discussion with other satellite operators and spectrum owners to contribute to this setup. Our interest at the end of the day is to create the most formidable infrastructure in space where we will have a contribution, but we don't want to own this lock, stock, and barrel, i.e. exclusively, because ultimately our forte, our capability, our expertise, our savoir-faire is about delivering a mobility service to the end user. And to be able to do that in a sustainable manner, in a competitive manner, in a differentiated manner, we need that assurance that we'll be able to rely on the most formidable infrastructure, and that infrastructure will continue to evolve in a sustainable manner, economically and technologically. And so we threw our hat in the ring to create this setup in space. And in fact, that replicates a successful experience of our companies on the ground. And so many of the analysts on this board are familiar with this model. But again, our interest is to be able to rely on this, deliver now services to billions of users in markets where A, we have presence, B, we can bring to use our spectrum, and 3, where we have already established relationship with mobile network operators. And moving on to the second tenets, Viasat and Space42 together bring the first and the largest L-band and S-band globally harmonized spectrum pool, which will give us immediate access to 180+ markets, which is quite unique. Standard-wise, we're following the 3GPP NTN standard, again, to be able to deliver this particular service, which is quite unique to unmodified devices in the future. The fourth tenet is, and this is fact, we bring decades of credibility serving the mobility market from space. So this is not a new endeavor. This is not a new flavor of the day. This is our DNA. This has been our bread and butter for decades, as well as for our partner. And we therefore bring an operational security, economic efficiency expertise that is matched by no other service provider. And last but not least, our approach from the beginning is to team up with MNOs, i.e. while we will deliver a service to the end user, that service delivery will be done through the mobile network operators who have a relationship with the end user, whether it's a business entity, whether it's a dwelling home, whether it's an individual. But the point I want to make is our work will happen in tandem with our relationship with the mobile network operators. Now, page 10 gives you a sense of the opportunity we are prosecuting. It is unprecedented. I will posit that today the mobile satellite services market serves probably just under 10 million users. There's public information around it. So we move from a pool of single or double-digit million users to a pool that can be expressed in billions of users in the next 3 to 5 years. And you can therefore appreciate that this is a generational opportunity for us. We're taking a conservative view as to what does this equate to in terms of monetary value. And so these are our own conservative projections. You have seen and we have seen much higher projections for this particular market. We have used these particular projections to stress test our business case for Equitas, and as well as our business case as Space42 service provider going forward in the NTN agreement. And so, notwithstanding our constructive approach, this is a multifold evolution to the business we currently serve today, which leads me to the concluding page on this particular topic. What's in it for us as Space42? First, this is a accretive investment, i.e. our investment in Equitas as a co-founder. The capital commitment we will bring to bear to participate in setting up Equitas is commensurate with the GeoLive mission. And for those of you who have been following up our business can sort of understand what this number would look like. We took a view from the beginning that given that this is a de-risk infrastructure, it has to deliver the IRR that is commensurate with our geostationary-like business. And so this is a double-digit IRR unlevered, which meets our financial framework criteria. What's also in it for us is this is an unprecedented value enhancer to the Space42 L-band spectrum, which you could visualize on the right-hand side of this page. Covers the African, European, and Asian continent down to also including Australia. And so while we were bringing and sweating our spectrum using our traditional geostationary spacecraft and delivering the service to modified devices, this is a very different league, i.e. now our spectrum will be able to deliver value to users around the world on their normal devices, since these devices will be enabled with chipsets that can serve and operate in these spectrum bands. And therefore, this is a growth multiplier as far as we're concerned, since we are moving from the existing TAM, which I described briefly earlier, to a TAM that is growing by 3 orders of magnitude 3 years from now, i.e. when we will start serving this particular market. And our starting point is quite strong, since we have the benefit of established agreements with mobile network operators. At the last count, we have 380 such agreements. And we already started to sort of refresh these agreements or these partnerships and these working relationships, so in order to gear them now specifically towards this new generation of mobility services using space-based assets. And on core pillar number 4, I want to conclude by emphasizing the importance of ALIA 4 and ALIA 5, which are very significant programs for us, both in terms of bringing a unique technology, serving a book of business that is already committed for the next 17 years, which in fact will start generating revenues to the tune of 300 million annually from Q4 2026. That's part of our agreement with the UAE government. And so it is important that we bring you up to speed on the fact that the program continues to develop as planned, i.e. the program is developing on spec, on time, on budget, so that the two assets are become operational as visualized on the slide in front of you. The last point I want to sort of mention so that I can link this to pillar number 4. Our intent is to complement these capabilities with non-geostationary capabilities going forward, and we're in the final stretch of our discussion with a global partner to be able to do that, so that at the time when ALIA 4 and ALIA 5 are launched, we're able now to operate across multiple orbit to serve the secure requirements, which is part of our commitment to the UAE government. So in summary, we remain faithful to our strategic plan, and we continue to be guided by the 5 principles that we have covered repeatedly. Programmatic growth remains our North Star. The differentiated capability is the criterion that qualifies each and every investment we make and each and every effort to bring to the market a product or service. Scalability matter. Every initiative I have outlined to you so far, and we will outline going forward, has global reach. This was part of our press release back in December 19, 2023, when we talked about the raison d'être of Space42, and this remains an important filter. If we can scale, we will not do it. Full stop. And last but not least, our financial framework will keep us honest and faithful to our covenant as well as to the objectives, the financial objectives we want to achieve. And over to you, Andy.
Thank you very much, Karim. So good morning, good afternoon, everyone. Thank you for attending this call. I will just take you through the 9-month results now. So on page 15, I think overall we would characterize these results as a resilient and robust set of results. And as Karim mentioned, we have very sound fundamentals, which I'll come on to. It is true that the revenues are a bit softer this quarter relative to the prior year. We have managed to mitigate a lot of that through a reduction in costs. And as a result of that, you'll see that the EBITDA margins remain robust, slightly lower, but still very, very good. The revenue shortfalls come really from the Smart Solutions business, and it reflects 2 key drivers. One is the ongoing transition that we're making in that business from one-off projects to programmatic engagements, which is very, very important because we want to be in a position to be able to have a stable and sustainable and predictable revenue stream in that business. So we're making a lot of progress there. And the other is delays to the achievement of certain project milestones and contract awards. So these are very much of a timing nature, these revenue shortfalls, and we expect to rebound strongly in the near future. Now, the good news is, despite that revenue shortfall, the space services business, which accounts for 85% of the group's revenues, has done very, very well indeed. It has grown every quarter this year, 3 consecutive quarters. It grew its revenues in Q3 by 11% relative to Q2, and typically Q3 is generally the weakest of the 4 quarters. And of course, that's underpinned by the coming into service of the T4, Thuraya 4 next generation satellite from the 1st of July this year, which is a key growth driver. And I expect Q4 to be an even stronger period for the space services business. So space is doing exceptionally well. And then when we stand back and look at the balance sheet as a whole, this is a very, very strong balance sheet. We have cash at the end of September of $755 million. We have negative net debt. We have negative leverage of minus 1.7 times. We have contracted future revenues of $6.7 billion, which if you just stand back and think about it, it's 11 times the annual revenues, the last 12-month annual revenues of this group. And this is really quite unique in the industry. And on top of that, we have an undrawn BPI-backed ECA facility of $700 million. So the group is in a fantastically strong position with a very, very robust balance sheet with which it can execute its growth agenda, most notably the D2D initiative that Karim's just mentioned. Now, the following page gives you all the numbers, and I'm not going to go through all of these line by line. You can see kind of the dynamics taking place here. So the revenues, as I said, is softer coming from the smart solutions business as we refocus it. You'll see the cost of revenue proportionally has fallen by a greater extent. Therefore, the gross margin is actually in line, if not slightly ahead of the prior year. The staff costs and the other OPEX are stable versus prior year. And this is notwithstanding the fact that during the year we have invested in some of our growth initiatives, such as the D2D. Okay, so on a normalized basis, you strip off the one-off items. Actually, our cost base in total is down about 10% year on year. Now, the other income is a lot lower than prior year. Many of you will remember that in the prior year, we received $30 million one-off liquidated damages related to the procurement of Thuraya 4. So when you put that all together, the EBITDA is lower year on year. The margin is a bit lower. On a normalized basis, there at the bottom of the page, you can see the margin is still pretty robust at 43%. And below EBITDA, we see a number of items trending favorably, whether it's depreciation, extraordinary items, finance income is pretty much in line. Page 17 then gives you the normalized results. And the reason we do this, for those of you who are not aware, is that every year there's always one-off items. And so in order to provide a like-for-like comparison, we strip those out. So on a like-for-like basis, as you can see, the profitability is lower, reflecting the ongoing transition in smart solutions, but nevertheless, the margins are still decent at 44% for EBITDA and 70% for net profit. Now on page 18, we show you the revenue evolution. Now, the first thing you notice here, the split of revenue. So 85% of the total revenues is coming from the part of the business that is growing consistently and strongly, okay, which is the space services business. And as I said earlier, it's grown every quarter this year, and I expect that to continue and indeed accelerate in Q4 as we start to commercialize the 15 or 16 new products that are being launched relating to the Thuraya 4 satellite. The smart solutions revenues are lower, as you can see, reflecting, as I said, the ongoing transition, and also the timing, as we have, with this business, the timing of the completion and execution of contract awards and milestones. But as we progress the transition of this business, we expect to be able to establish a more sustainable and predictable revenue profile. And as Karim has already alluded to, with the launch of a further 3 LEO foresight satellites and the ongoing development of the GeoCube GIX platform, we are finding ourselves gradually in a place where we will be able to achieve that sustainable profile. And you can see already, actually, from Q3 to Q2, the revenues in that business have increased from 11 million to 25 million. The following page gives you exactly the same split but for EBITDA. Now, year on year, this isn't comparable because, like I said, included within the prior year are the $30 million of liquidated damages. We strip that out, then yes, the EBITDA is down by 22%, reflecting the smart solutions performance, but also the ongoing investment we're making in some of our growth initiatives, notably the D2D. The main contributor, obviously, to EBITDA, you can see here, is space services. And it's worthy of note that on a normalized basis, the space services EBITDA is up double digit, it's up 10%, and the margin is 66%, probably almost the highest normalized margin I've seen in the space services business in its history. I think one year had 67%. So that's performing extremely well. Page 20 gives you the roll-up of our future contracted revenue. This is our backlog, $6.7 billion, 11 times annual revenue, huge visibility and security over future cash flows, so no major changes there. It's dominated by 3 or 4 long-term contracts with the UAE government. You can't think of a real better customer, really, when it comes to creditworthiness as well there. So that is a very unique feature of Space42. Page 21 shows you the cash evolution. No concerns here. It's true that the cash balance has fallen by 400 million since the start of the year, but we have paid down a considerable amount of debt during that period of over 300 million. And it's probably worthy of note here, it's not captured in these numbers, but in October, post the balance sheet date, advance payment of the LEF-45 $5.1 billion government contract of $300 million. So if I was to draw up a balance sheet today, I would expect the cash balance to exceed $1 billion as of today. So very, very strong cash balance. Page 22 gives you the overview of the balance sheet itself and how it has evolved since the start of the year. No major surprises there. The capital work in progress, which up until the start of operations at T4 captured all of that cost, that is lower now as the satellite has transitioned to fixed assets. So that's just a straight kind of switch. Of course, we are now depreciating that asset. And you can see the cash and short-term deposits, as I said, has come down, but so too has the borrowings, which you can see is falling significantly. So very, very strong balance sheet, a decent, robust performance. We've done a lot of work in transitioning the Bionat Smart Solutions business, and that work continues. And of course, last but not least, page 23, we'd just like to remind you all of our financial framework. And this really sets the principles upon which we deploy capital. It hasn't changed. We're completely consistent with it. We deploy capital along these three pillars. One is organic growth. So think of LEF-4, LEF-5, 17-year contract there, or Foresight constellation. The second is inorganic growth, where we would look to make strategic bolt-on acquisitions that are accretive. And the third is returns maximization. So this is where we look, obviously, to grow the company, grow the value of the company, and also return to shareholders cash in the form of dividends.
We will now begin the Q&A section of our call. Please feel free to post your questions in writing on the chat or raise your hand feature, and I'll call you to ask your questions. First question from Zayed. Zayed, please go ahead.
So on the D2D venture with Viasat for the network construction in space, roughly what is the expected cost in terms of OPEX and CAPEX over the next 3 years? I understand it's a phased investment. And eventually, who would bear or pay the bill? Would it be your telecom partners as a wholesale agreement, or is it going to be the end users using their mobile for connectivity? And if you could tell us what is the expected IRR profile you have for such a business?
So in answer to the first question, and I will describe the construct, we have made an investment in Equitas. This is by nature an infrastructure-related investment. So Equitas will be a de-risked infrastructure service provider based on the infrastructure that they have. So effectively, we create Equitas. Equitas will commission, deploy, and operate this infrastructure in space. And we, as well as our partners, will lease this capacity from them. Our investment in Equitas as the service provider from a capital investment standpoint is commensurate with an investment that typically is comparable to a geostationary spacecraft, so a Thuraya 4 type of mission. So that starts answering, I think, part of your first question. Now, we're not giving the exact number. This will be part of the announcement regarding the next milestones of Equitas before the end of the year, which should be an announcement that we and Viasat will make together, and possibly there will be another partner in this conversation. But I just want to make sure that you understand the construct. It's a joint investment going forward that will fund a shared infrastructure that will be sold commercially to the founders and possibly other service providers on the basis of SRUs. So you will see going forward reference to space resource units. So we will lease these SRUs from Equitas, we, Viasat, and others. The purpose of these SRUs will be to give us access to these space resource unit at the lowest unit cost possible. Because at the end of the day, the stress test is not to be able to deliver a connectivity from a space-based asset to a unmodified form. We know we can do that. The crux of the issue is to be able to do that with a user experience that provides continuity of the mobility experience that you and I enjoy every day, one, and be able to do this within an economic envelope that is comparable to what you and I pay or experience as an average bill per month, so that it is not a disruptive economic factor on any individual. So you need to think about now, once you understand that we made an investment to set up the infrastructure, you need to think about us now leasing capacity from this infrastructure provider or owner to access resources that then we will use to deliver a service to the end user. The service to the end user will be done through our agreements with mobile network operators. So if you move backward, the $1 or 1 dirham or €1 that is generated from an end user at the end of the month, there is part of it that is retained by the MNO, and the balance, the majority, is then captured by the service provider, which in our case is Space42. And this revenue is then used to cover the leasing of the capacity that we would have acquired from equities. So you need to think of it as a three-step approach. And so for us, it will be accretive at two levels. One, through our investment in equities, because this investment, based on a very conservative assumption, will deliver the double-digit IRR that I was referring to. And two, it's accretive to Space42 because we are a service provider. So we will be acquiring this space capacity, packaging it, providing this now as a service to MNOs, and MNOs commercializing the related product and services to their end user. So there are two ways where this would be accretive to our business. I hope I've answered I started to answer part of your first question, with the understanding that we provide more clarity and certainty with specific numbers before the end of the year on this particular front.
Yes, that's very clear. Thank you, Karim.
Okay, very good. Now, the second question was covering smart solutions. This is work in progress, and what I want to describe to you, and then I'll make it very short, is there were 2 to 3 phases to our approach. One was to take stock of the projects that were already engaged that we need to bring to a conclusion, and this work is underway. These are not projects that fit the 2 core pillars related to smart solutions that I've already covered. But nevertheless, we have contractual commitments to deliver them. And so we intend to conclude on these over the course of the next 6 to 8 months. So somewhere mid-2026, we would have delivered most, if not all, of the legacy one-off projects that were part of the legacy smart solution business. In parallel, step number 2 is to build the capabilities that are front and center to core pillar 1 and 2, specifically the Earth observation capabilities, i.e. capabilities or the assets that will allow us to capture data from space, and B, the capabilities on the ground that allows us to derive the SOA, as well as the capability that allow us to put some of this data to action, specifically the thematic focus on autonomous mobility. Part of this business already exists, but hasn't been scaled yet. So we're in the middle of that. And so we expect to sort of complete this work in progress, which is work stream 1 and work stream 2 over the course of the next 8 months, i.e. we should be able to put smart solution on the track that is in sync with our business plan over the course of 2026. And I would not be surprised to start seeing the results of that, or start seeing some of the results of that in our Q4 2025 results. But on a steady state basis, completing the legacy project and single-handedly focus on the forward-looking engagement, programmatic engagement capabilities that we're in the process of commercializing, that is a 2026 priority.
Got it. Thank you.
Thank you.
Well, we have one more. Let me open up.
Hi, this is Shahrukh from BankFab. I have questions on the revenue. Like, what is your expectation for the revenue? Do you expect it to be lower on the fourth quarter 2025 and the first half 2026? And is there any upcoming projects which will support the 2026 and 2027 timeline? And on the cost side, do you expect the finance cost to be higher in the upcoming periods? And what is the expectation for the COGS? These two questions I have.
Okay, thank you for your question. Now, as you know, we don't give guidance, but certainly I'll give you a kind of directional feel. For the space services business, as I said, we've already seen 3 consecutive quarters of growth, and I expect the fourth quarter to be stronger still. So certainly for space services business, I would expect pretty decent mid-single-digit revenue growth in 2025. For smart solutions, I would not necessarily expect growth in 2025. As Karima said, we're undergoing the transition process and that, and we expect that to return to growth in 2026. And some of the key growth drivers for smart solutions will be one particular very significant project, which is going through the senior level approval stages at the moment. That is expected to drive growth next year. I can't give too many details about that project. There is also the commercialization of the Foresight constellation. Now we've got 5 satellites up there. Expect that to drive revenues next year, both from a commercial and government perspective, and also the ongoing development and scaling of our GIQ-GIX platform already on Microsoft Azure. It has several hundred users already. So those I expect to be the main growth drivers in revenues going forward into 2026. I think you had a question about finance costs as well. Is that right?
Right.
So generally speaking, the finance costs will go up next year, and that is a function of 2 things. The first is that when we draw down on the ALIA 4/5 ECA-backed debt facility, obviously we will have more debt, okay, and that is carried at a higher level of interest, reflecting the market conditions prevailing today. So at the moment, you're probably aware we have an all-in cost of finance of about 3.3%. That will definitely go up next year as we draw down on that debt. But also, you might be familiar from an accounting perspective that you are able to capitalize your finance costs whilst the ongoing project is taking place, or at least a portion of those. And now that the Thuraya 4 satellite is launched and operational, the outstanding debt specific to Thuraya 4, which is still running at about, by the end of this year, roughly $200 million or so, those finance costs will no longer be able to be capitalized. So those are really the key drivers for the higher finance charges.
And also, can you highlight about expectations on the COGS?
Okay. On the COGS, okay, so for, I mean, there's 2 questions there, right? Because we've got to look at the 2 different business units. So for space services, the gross margin, I do not expect to be significantly different year on year going into next year. It may be a little bit lower because we will be purchasing a little bit more third-party satellite capacity, but overall, in the grand scheme of things, it won't be that different. And I'm expecting on the smart solution side, as we transition that business, I'm expecting the gross margin to be higher as we develop and deliver more high-margin projects in 2026 versus 2025. And as we bring on, as Karim said, those programmatic capabilities into the revenue profile.
Any final questions? Well, thank you all for your time, interest, and thoughtful questions. If you have any further questions, please don't hesitate to reach out. We look forward to connecting with you again soon. Thank you.